Good morning, good afternoon, good evening. Thank you very much for joining our seminar. Our discussion today is about ETRM systems and the best practices for such systems. To start with, we have a disclaimer that this presentation is not a suggestion or advice to perform any business activity, and that includes investment or trade or sale or purchase of any items. ETRM systems, we need to see how the market has evolved through the years. The deregulation of the gas market in the United States took about 60 years. In the 1930s, where we are here, the United States government realized that natural gas was an important commodity and hence heavily regulated the market. In 30 years, FERC, which is the Federal Regulatory Commission for Energy, took over and started easing up the regulations in the market. By 1985, FERC Order number 436 started debundling the pipelines. Basically, access to pipeline was restricted before this order, and after that, the order allowed the third party to access the pipeline. By 1989, natural gas wellhead deregulation happened, and basically the price of gas at the wellhead became deregulated. By 1992, order number 936 came about, which basically allowed the prices to float, and after this, the deregulation of the gas market was complete. From 1992 to now, for about 30 years, the ETRMs have had the chance to evolve from earlier stages, which was stage 1 to 2 and 3. So basically, the ETRMs have had 30 years to evolve, meaning that now all the bells and whistles work, everything is fine. So if you compare one ETRM system with another ETRM system, at least on the face of it, it seems they have similar functionalities. But the reality is that the trade flows are changing significantly. Flows are now global. COVID-19 has shown us the supply chain is extremely sensitive, and the portfolio boundaries are now global as well. Before, if I had coal in the United States, I was only exposed to the United States market, but now coal is an international commodity. So although on the face of it, the ETRM systems may look similar, in reality, we need a new approach to make sure we are choosing the ETRM system that is suitable for our business activities. To start with, if we look at the ETRM is actually a container, meaning that my organization has different divisions: legal, trading, marketing, operations, and so on and so forth. These organizations come together, and in the intersection of these organizations is where the activity of the organization happens. At the same time, each organization has its own functions. They have contracts to look at, markets to analyze, operations to perform, and so on and so forth. And ETRM is a container that allows to look at the global risk profile of the organization. Hence, it has to allow for the functions, it has to allow for the organization, and the interconnected functions that they have with each other. Hence, if we are looking at an ETRM system, we need to make sure that the functions and the functionalities and the organizational structure and the interconnectedness is observed. At the next level, we need to be careful because risk is a cycle where we identify, measure, aggregate risk, report it, treat risk, and verify. This vigilance circle is a constant process and continually needs to be observed, which means we need to apply this circle against the organizational structure that we have. So if we have an ETRM system that has the organization, but we cannot apply this to it, then that might not be the ETRM system that we should be looking at. Now, in a simple view of a commodities life cycle, we produce, we refine, we transport, and we deliver. Here, time seems to be linear. But if we look at it a little bit more closely, we realize that, for example, in the marketing, we buy, then we transport and sell and make sure that we are getting paid and we have to pay our taxes. But then life continues and we buy more and so on and so forth. So we go in circles. And of course, each of these could get a global interruption. Hence, our risk management system not only has to follow the linear time, but the cyclic and global nature of the business, which means I have to apply my risk vigilance cycle to all of such activities. So your risk vigilance should be on multiple frequencies. It could be quarterly, it could be daily, and if you're trading power, it could be hourly. We also have different views in the organization. Let's say from the corporate point of view, we have a mine in Chile, and we are going to sell our product in Germany. So from the corporate point of view, we have a demand center called in Germany, or is in Germany, and then supply is coming from a place called Chile. From the corporate point of view, we are concerned about, is the capital available? What's my weighted average cost of capital? How does my discounted cash flow works? What about environment, health, and safety? Very important. What about compliance? Am I compliant with the anti-money laundering laws? Am I compliant with the local laws and regulations? And of course, we have auditors which are external and internal to control our actions. So an ETRM system should allow us to answer such questions from the corporate view. However, that's not the only view. If we look at the marketing, now marketing's view is a bit more detailed in this sense, that no, not only I am doing supply to demand, I am buying a cargo in Chile and I'm selling a cargo in Hamburg. So the locations are very important, and questions like how much supply, how much demand, what's the client base, what's my netback price, do I have an inventory at LME? What are the prices at Sheffield, which is basically in China? And the global markets say that the prices in Sheffield are going to impact the prices in Germany. So from the marketing point of view, we have a different view than the global view from the corporate view that we have. That was a marketing view. We can now look at the ops view. For the ops guys, they are even more detailed. They say, I have to load a cargo and discharge a cargo. Hence, what's the pier for the cargo in Chile? What's the same pier size actually in Hamburg? What kind of a channel am I getting? What's the deep, the mean tide? Because the mean tide is very important, especially if you're, say, trading LNG. Hence, from the ops view, all these details of the ports and the functionality of them are important. As you see, we have different views with different requirements. Our ETRM should allow to do all of that and then ask ourselves, what's market risk? What's credit risk? Operations, human risk, funding, regulation, etc., etc., etc. So an ETRM is actually a confluence of all these views together, and the ETRM should allow this corporate structure and view for us. Now, if we look at the business cycle, it is unpredictable. If it's unpredictable, then our system should be able to cope with predictability or lack thereof. Look at our trade, which was, say, buy copper from Chile. The first stage is called cathodization, which basically you purify your copper into cathodes. Now that I know this is being produced, I can go ahead and say I have to buy FOB, and then because I'm buying, I'm sure that I have to load it, so I can plan my load. So the very first thing is that my ETRM should allow for supply, And if the supply is actually equity, I should be able to see it. I should be able to buy FOB, DES in whatever format, and I should be allowed to plan for my operations. That being said, I have to sell this. So when I sell it CIF, then my ETRM should allow me to actually allow for CIF costs. And not only that, it should tell me that it takes 25 days based on the cargo that you have to start from Chile to go all the way to Hamburg. So my ETRM should allow for time schedules and scheduling of the cargoes. And then I can ask myself, what is my market risk, credit risk, operation risk, at sell, at buy, and the measures that I use? What's my P&L? What's my VAR? How much FX exposure I have? Because in Chile, I have to pay the local currency. In Germany, I may be receiving in euro, so I have FX exposure. And then what's my ARP? Do I have collateral? What's PFE? And so on and so forth. So this risk circle is applied across this timeline and with these measures. However, even at this stage, being so complicated, we have a static view. Life is unpredictable. We actually had a port strike in Chile. Well, if the port strike happens, then probably my load is going to change, which means, do I have to do force majeure on my sell? The topic of force majeure, which is extremely important, especially for larger cargoes such as LNG and maybe crude oil and some other commodities, is a very important topic that the ETRMs should allow us. If I'm force majeuring, when is it? Can I do so? What are my contractual agreements? So the system should capture this. If I decide that I don't do force majeure, then I know that I have to change my loads and my buys. Hence, my system should allow me flexibility to do this quickly and then know what the consequences are. If I load later, then I have to sell later. And now I have to ask the same questions. What's my P&L? What's VAR? And so on and so forth. So this type of flexibility should be available such that we can react to the market conditions as they change. Now that I know I'm loading, I can have my notice of readiness, I can have my voyage, and then I can send a provisional invoice. Hence, again, my ETRM system should allow for notice of readiness and the voyage and the invoicing and so on and so forth. When a provisional invoice comes, then my credit exposure certainly changes. So invoicing and basically the back office is a part of ETRM. This is just the planning and buying and so on. So that's the front office. This is ops. This section is finance and treasury. So ETRM should allow for all of those, which basically means now I have to have my finance invoice, I have to know what my inventories are, and so on and so forth. And at the end of it, I perform my delivery, and still at delivery, I should make sure that my exposures are nil. I have fulfilled my commitments, and I don't have any exposure. This little animation, I hope, is not too much, but it shows that life is difficult and unpredictable, and ETRMs should actually facilitate dealing with such situations. Hence, an ETRM should provide flexibility from the front office point of view, from the mid office, from the back office, and we need to seamlessly transition functionally between these sections of the business. However, not all is doom and gloom. We take risk because there is opportunity. So what the ETRM helps us to do, and hopefully it does when we look at these systems, is that it allows us to turn the risk into opportunity. How do we do that? Okay, I had my capitalization, I was buying, I know I sold it, I even planned my load, and the port strike happens. We saw how we dealt with it, and the ETRM allowed us to restructure everything all the way from start to end and push this forward. But now, if we have an ETRM that works for us, we can ask ourselves, hang on, if the port strike happened, the supply was going to go down. If the supply goes down, actually prices out east are going to go up. So maybe there is an opportunity for me to sell to Shanghai at Sheffield prices rather than to Germany, which actually this is what happened. This is a real story from how the prices change. So I can ask myself, maybe I have to reroute my cargo, being an LNG, being a copper, being another commodity. If we have an ETRM system that allows us to run these scenarios, then we can make the decision. In this case, first, I have to unwind my CIF at Hamburg, which I should know if I have an LME warrant available to me to match this. So again, our ETRM system should allow us to see our inventories. Let's say we do, I use my LME warrant to cover my position. Now I'm going to sell it to Shanghai. However, in Shanghai now I have FX risk because probably I will be selling it in the local currency, which is renminbi. Hence, the ETRM not only should give us this possibility, it should always tell us, okay, what are the exposures? How did the exposure change? I had a euro exposure that went away. Now I have a renminbi exposure. Moreover, it's not 25 days to Shanghai, it's 28 days. So now I have to plan my operations differently. So my load is going to change, hence my NOR is going to change, my voyage is going to change, and of course, the delivery is going to change. The morale of the story is that the ETRM should provide us a way to transform the risks that we have into opportunities by giving us a good view of the world and what we could do. The next stage is that if we look at our portfolio, this was a very simple view. One buy, one sell. There could be many buys, many sells, or even this is copper, we could be buying and selling LNG to different locations. So an ETRM should allow us to look at the global portfolio and hence have a good view of how the commodities interact, how the position interact, and what's our total risk across the industry. Doing so, now let's have some examples. Many thanks to Enuit for allowing me to use snapshots from their system in trade. First of all, as we said, we need to have organizational structure. In this case, this is the parent company. I have my US and I have my Beijing offices. They have their own, say, physical oil. And then I could have a long-term supply, mid-term supply. I could have my inventory and so on and so forth. Or I could actually be involved in oil derivatives. So it's extremely important to be able to capture this structure of the organization and different portfolios and sub-portfolios. The next step, as we said, is that, well, we need to have our price curves because we want to price. In this case, I have an ICE Brent. From my ICE Brent, I can get my first line swap, which is used for dated Brent. If you're trading oil, these curves are very important. At the same time, you might have actually a Platts PFOE that you need to drive from ICE through your EFPs. So having a valid and robust curve structure is important that tells you what your curve is. Is it a price curve? Is it financial or physical? Is it an input curve or a derived curve? Is it a settlement curve or a forward curve? So you need a very flexible and very robust curve structure such that you can build the curves and see them, how they are related to each other or related to each other. After that, of course, we have to make our derived curves. If I have LME copper, then I have to have my third Wednesdays, because as we know, the deliveries on LME are on the third Wednesdays. And then I can have my physicals. So not only I need to have my base curves, I need to have my derived curves. Operationally, in this example, we are buying a few commodities, putting them together, and then the other commodities, putting them together, and finally making one delivery. So the operational activities that we can do in terms of blending, buying and selling, again reblending, and so on and so forth, have to be available through your ETRM system. A very important part of ETRM is workflow, because we can't just buy and sell without oversight. From the trading front office, we enter the deal, then the trading manager has to go and approve it. If it's not approved, you cannot go to the next step. When it's trade approved, then the risk manager has to approve it. When the risk manager is approved and the contract is happy, we confirm it, and then it is locked such that it cannot be changed. Many of the problems and irregularities that happen in the business is that because the risk flow, or actually the workflow, was not properly locked down. So your ETRM should allow for a seamless workflow such that you can have barriers, segregation of duty, and checks and balances to make sure that the rules are followed. And of course, at the end of the day, we want to know our position. If I look at my RON 91, I want to know how many positions do I have. Well, I have short 530,000 barrels here, and another short 6 million barrels here, and another day, and then another one here. Whereby, if I look at my MOGAS position is 3 million long. So it's very important for the ETRM to give you per commodity, per time schedule, delivery starting, delivery ending, what trade it was, what your position is. When you know your positions, of course, you want to know your exposures. The exposure basically says, okay, I have a physical deal, it's a MOPS 92, and by the way, my exposure for the month of May is 525,000 barrels. Exposures is what drives the risk. This was a view of the ETRM system, but at the end of the day, of course, everybody needs to know how much profit or loss we have made. Hence, we need to have the profit and loss across the time and across the other grids, for example, in long-term supply or inventory, and so on and so forth. This is what's the bottom line, and that basically the ultimate goal to make profit. Hence, the P&L report is extremely important. This was a very quick review of the ETRM systems and the necessities that the new business world is requiring. So to summarize, yes, for all the ETRM systems, the bells and whistles now work. On paper, they look similar, but one has to go deep, analyze them, make sure that they have the correct structure and they meet the requirements that we have. Thank you very much for your attention, and I hope you enjoyed the presentation.